Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our conventional tanker market update for July 2016. Now, as we move into July and the second half of the year, it's perhaps a good chance for us to look back at the first half and see what happened in the tanker market in the first half of the year, and then talk about what we think is going to happen for the rest of the year and into 2017. And if you remember, coming out of 2015, we came out of a very strong tanker market in Q4. And some of that strength did spill over into Q1 of this year, and that's because a lot of the strong fundamentals from 2015 remained in place during the early part of the year, namely low oil prices, very high oil supply, and a lot of stock building and stockpiling going on around the world. But as we've got further into 2016, into the latter part of Q1 and then into Q2, we have started to see some headwinds emerge, which have affected the tanker market. First of those is that global oil supply is no longer growing like it was in 2015. Last year, global oil supply grew by more than 2 million barrels per day. But what we're seeing this year is only in the Middle East has oil supply grown. Everywhere else in the world, whether it's West Africa or Latin America or North America, we've seen oil production actually decline. And so on a global basis, global oil supply has been flat, and in the last couple of months has actually declined year on year. So that's been a slight headwind for tankers. We've also seen a slowdown in refinery throughput, and we've seen that some of the refineries have not enjoyed as good margins as they did last year. So there's been less crude moving into refineries, and really that's a reflection of the fact that global oil inventories, especially on the product side, are very high. And so the refiners haven't been making as much money on the product side, and therefore their margins have shrunk, and they haven't been as incentivized to run the throughput levels as high as they did last year. And then the third point is tanker fleet growth has accelerated this year. The tanker fleet grew by just over 3% last year, and we've already seen almost that level of fleet growth just through the first half of 2016. So this kind of slowdown in global oil supply, very high oil inventories putting pressure on refining margins, and accelerating fleet growth is leading to some headwinds, and we're seeing that in tanker rates. Through the first half of 2016, VLCC rates have been down by about 10% year on year, and the mid-sizes, the AFRAMAX and the SUEZMAX, have been down by about 1/3. And the VLCCs have held up a little bit better because, as I said earlier, the one region in the world where oil production has been growing has been the Middle East. We have seen some quite strong exports out of Iraq and Saudi, and of course from Iran as they exited sanctions. And we've also seen quite high crude oil imports into China this year. Chinese crude imports in the first half of the year averaged about 7.5 million barrels a day versus 6.5 in the first half of last year. So that's quite a big increase in crude moving into China. And because crude output from the Middle East has been high, and we've seen a lot of imports going into China, that's meant that vessel congestion in those two regions has been pretty high as well. So the VLCCs have been a little bit better supported, whereas the SUEZMAX and the AFRAMAX have seen some headwinds from what's been going on in the Atlantic basin on the supply side. We've seen some supply outages from places like Venezuela, which traditionally supplies cargoes on AFRAMAX up to the US Gulf region. And we've seen reduced supply out of Nigeria because of militant action on the pipelines there, which has lowered Nigerian production from 1.9 million barrels a day at the start of the year down as low as 1.3, and now back up to about 1.5 million barrels per day. And that's meant fewer SUEZMAX cargoes. And earlier I also mentioned the refining margins, and I think that's been a negative for the mid-size as well in the Atlantic, particularly in Europe. One of the big surprises from last year was that the European refining margins were very strong, and this supported a lot of crude imports into Europe on AFRAMAXs and SUEZMAXs, whereas this year we've seen that the margins have been much weaker, and therefore there's been less incentive to import as much crude into Europe on the AFRAMAXs and the SUEZMAXs, and that's dampened the rates, particularly during Q2. Looking ahead into Q3, we do think that there's some scope for rates to get a little bit better as we go through July and into August. Refinery throughput is expected to recover as we go into Q3. In fact, the IEA says that the jump in refinery throughput from Q2 to Q3 of this year could be the largest on record by as much as 2.3 million barrels per day. So we would expect to see more cargoes in the next couple of months, more activity, which should translate into higher rates. Nevertheless, as we do go further into 2017, we do think that some of these headwinds will intensify, particularly as the oil market starts to rebalance. As I said, oil supply is no longer growing, and what we might see, instead of stock building that we saw over the last 2 years, as we go forward, we might start to get into some stock draws, which obviously is not as positive for tanker demand. And then on the fleet supply side, as I touched on earlier, we still do have a lot of ships set to deliver in the next 12 to 18 months, particularly on the VLCCs, and then as we get into 2017 on the SUEZMAXs. So we do expect that fleet growth this year will be about 5.5% to 6%, and another 5% fleet growth next year. And so we do see that as we go into the remainder of 2016 and then into 2017, there are definitely some challenges that the tanker market has to face. But having said that, we do think that any sort of downturn in tanker freight rates in the next 12 to 18 months will not be as severe as we saw in the period 2011 to 2013. And we don't think that the next downturn will be as long-lasting either. And in fact, one of the big positives for tankers as we look further towards the end of the decade is the fact that no one's really ordering new ships at the moment. The level of new tanker orders this year has been very low, and that sets the stage for some quite low levels of fleet growth as we get into 2018 and 2019, at a time when we do expect oil production to go back towards the OPEC countries, an increased call on OPEC as we go towards the end of the decade, and those barrels are typically long-haul, ton-mile intensive barrels. So we do foresee a situation in a couple of years after we've got through this present set of headwinds where we'll see a stronger tanker market again going into the latter part of the decade. So that's our update on the conventional tanker market, and we'll talk to you again next month.